What is going on, guys? Welcome back to the Wisconsin Investor Podcast. I am your host, Reese Brown, filling in for Corey once again, coming at you with a solo episode today. And it is actually kind of a part two to a past Wisconsin Investor Podcast episode. Inspiration came from Corey's podcast a couple weeks back, 10 Deals to Become a Millionaire. And what we're going to be doing today is diving into that very first deal. So, 1 out of 10. We're going to be actually analyzing a deal kind of at a high level and then plugging that deal into a performa to see, after 5 years, where would we be? So super excited to get into that. A couple of things that I think we're going to find out today from these numbers is one, that cash flow can be kind of overrated at times. And two, on the flip side of that, um, equity and principal pay down, tied in with appreciation is something that's super underrated when we're analyzing deals. So I was thinking about deals that we could use as an example here. And I thought, why not use one that is live with Wisconsin Discount Properties right now? So instead of giving a shout out to our show sponsor, we are just going to break down a deal that is currently live if you're listening to this within a 2-day window of when it's coming out. So this is like the third or fourth week in April. I'm recording this earlier. So full transparency, I don't even have all the details yet for this deal. So if you're listening to it while it's still available and maybe looking at this deal to potentially put a bid in on it, make sure you go and look at all of the details on this property, because some of it I don't have yet. For example, the inspection report, I haven't gotten the physical report back yet. Um, but even if you're listening to this after this deal has passed, maybe it'll give you some FOMO, but will still really be it's going to be just as helpful, I should say. Um, I was planning on using a past deal before. I thought, why not use one that is live here? So if you can get onto YouTube and follow me along, I'm going to be sharing my screen on this one. That's great. If you can, if you're at the gym, listen to this on the road, don't do that. Don't pull it up on the road. I will try to explain everything in full detail. But if you can watch it on YouTube, I think it would be extra helpful. So without further ado, let's get into it. All righty. So I'm sharing my screen here, and we are looking at the buyer resource folder for a property on 1162 Pine Street in Green Bay. So this is going to be the deal that we're going to break down at a high level and then utilize that as 1 out of 10 to become a millionaire here. So first thing we're going to pull up is just property details. It is a single family home, a 4-bedroom, 1 bath. There is a full bathroom down in the basement of this property, but it's an unfinished basement. So I'm not even going to consider that as, we're not going to factor that in when we're looking at this deal. But could be a bonus to help it, sell or be rented, um, for the sake of this property and analyzing it. What am I saying? Okay. Anyways, the total square footage is just under 1,500. It's a nice big lot, a deep lot, um, 0.2 acres. It's got a 2-stall detached garage and then actually some yard past that. I think they got a little fire pit back there. And then this property was built in 1915, so an older one. Um, we've got a close date of May 28th, which is about 40 days from the time of recording this. So for those of you that are, considering using a commercial lender, and need to get an appraisal on the property, we should have some time to work that out. Other thing we're looking at here, annual tax is about 2,200, and then most importantly, our starting bid price of 159.9. So 159.9 is the number that we will use as we sort of break this down a little bit more. But next, we are going to go right into our calculator and kind of bounce back and forth between, rehab and ARVs from there. So our calculator, first question it's going to ask us here is our after repair value. So we'll bounce right back into some counts. We'll keep this quick, but there are 5 comps that we pulled ranging between $237,000 all the way up to $270,000. Doing some more research. I'm not going to go over all of this for the sake of time, but we are going to utilize after repair value of $250,000. I believe a very reasonable after repair value here. So ARV, $250,000. Purchase price, $159,900. Our holding time. So we're going to consider this to be a BRRRR, right? If we're doing the 10 deals to become a millionaire, we're going to be holding this property, we're going to be fixing it up and then refinancing it. So the time that it will take, I'm estimating at about 4 months before it's stabilized and the rehab is completed. The cost to hold the property during those 4 months, I have a total of $2,000 or $500 a month for taxes, utilities, insurance, lawn care, snow removal, that fun stuff. And then also our closing costs on that initial purchase. So, right, need to close with the title company, um, and those are around $2,400 to get the property closed. Our rehab scope. We're not going to dive into this too much. A main reason being, I don't have the full inspection yet as I'm looking at this deal. And it just, for the sake of what we're covering today, um, I don't think it makes much sense to dive into the rehab scope. So we're going to take an estimated rehab scope of $35,000, um, which should cover a lot for the kind of how much it would take to get this to, you know, reaching what the comps look like. One thing I'd highly recommend if you're actually looking at this deal or just taking this a little bit more seriously, and we'll include in the show notes a link so you can actually see all these details, even if it's months later when you're listening to this. Um, is looking at some of the comps and looking at the pictures of these comparable properties, and some of them aren't fixed up to the nines. So $35,000, I think, is a very reasonable rehab scope. So that's what we will use. And now we are going to talk about the different lending types here. Very briefly, I am going to be using hard money uh, for our hypothetical situation here. Hard money is what we're going to use as our initial financing type. Uh, but we can compare it to a commercial loan as well. For our commercial loan, that's just going to be there hanging out on the side. For those that are watching, you'll see it in a second here as I scroll down. For those that are listening, I'll mention it here what the total cost if you were to use a commercial lender would be. But we're going to say the amount that commercial lender or community bank is going to finance is 85% of the purchase price, 85% of the rehab. The rate is going to be 7%, and the origination cost for that loan is going to be around $2,000, and that would include the cost for an appraisal as well. For our hard money lender, we are going to say that they fund 65% of the after repair value, so 65% of the $250,000. Their origination fee is 3% of the total loan amount, and then their interest rate will be 12%. Some of you guys might be familiar with those numbers: 65, 3, and 12. Very common for hard money there. For the sake of running this, we're going to say, if you did want to flip it, realtor fees and commission or closing costs, oh my gosh, realtor commissions and closing costs would be about 5.5%. We'll just run through that very briefly. If you were to flip it, what you would make. And then most importantly, down to our BRRRR details. So our new appraised value, also our ARV, we're going to say is 250,000. The loan that the lender will give when we refinance is going to be 80% of that 250. So an 80% loan to value ratio. The interest rate, 6.5%. This loan will be amortized over 30 years. Corey had mentioned this in part one, I'll call it, of this podcast, about how some lenders will try to cut you at 25-year amortization. There are certainly lenders on investment properties that will go to that 30-year mark. So make sure you're talking to quite a few lenders. And then a couple other details are taxes each year are, we just covered those a second ago, around $2,200. Our insurance is we're going to estimate at $1,400 a year. And then our rent, we will go into rentometer or rentometer, whatever you call it, to take a peek at what projected rents are. So for 1162 Pine Street, we ran a Rentometer Pro report. The average rent came out to just under 2,100. The median amount was just under $2,000 a month. And there were some of these that had two bathrooms. So I'm going to be conservative and go under, even though some of these also didn't have a two-stall garage, right? I'm just going to be conservative in general, and we're going to drop it down to 1950 a month as our projected rent in this deal analysis. So 1950 is our rent amount monthly. So for those that are listening, we're now looking at a projection of what it would cost for the what it would cost you out of pocket if you were to use hard money. So the amount that you would be actually paying your hard money lender, for helping you get into this project would be about $11,000. If you were to use a commercial lender, community bank, that drops to about 6,000. So if you have the time and you got a little bit of money sometimes to put down, a commercial lender is a great option. And there are circumstances where those lenders will not require any down payment either. Not to get distracted here, we'll go back to hard money. So the amount of out of pocket funds required if you were to use hard money here would be about $36,000, and that would cover your purchase price and your whole rehab after that 65%. If you were to use cash again, obviously, well, let's not get into cash. We'll stay on hard money here. Gotta stay focused here. Um, Going down the details of the property. So all in, we have $162,000 is our purchase price plus our closing costs. For our rehab and our holding costs, we're at 37,000 for a total of around 200 and I think it's $210,000 is our rough total at that point. Now, if we were to flip this, say we want to sell it for $250,000, we sell it, we pay our realtor fees and closing costs. That's about 14,000. We could profit right away 25 grand on this deal. That's what all of our projections are saying. Forget the BRRRR that we just talked about for a second on those numbers. If we just wanted to flip it, we got about $25,000 if we were to use hard money. If you used a commercial lender, it's over 30, and if you used cash, around $35,000 as a flip. But we're obviously not talking about a flip. So if we decided to refinance it, that new appraised value again is $250,000. The magic number is 200,000 because that is 80% of our 250, which that's what the bank is going to cut you a check for. So out of that, 200. So we have 200,000 as our loan amount. However, our all-in cost, if you remember, was 210,000. So in this deal, if you were to use hard money, you would have after paying yourself back. So, right, we had talked about how you'd need to come out of pocket about $35,000 in this example. So say you had 100 grand in your bank account, you paid 35. Now your bank account says $65,000. You would still be paying yourself back $25,000 or so. And then you would be leaving an additional 10 grand. So your bank account instead of 100,000 like it was at the beginning would be 90,000. I kind of explained that poorly, but hopefully you get the gist that we're considering you paying yourself back cash that you stuck in the deal. So the amount left in is about $10,000, $11,000. And then additional details about the BRRRR is our rent amount of $1,950 a month. We added up our mortgage, insurance, and taxes, and each month that comes out to $1,568. So our cash flow is $382. Before you guys are already, I'm sure you're already like, oh, you're not factoring in capital expenditures. and, property management costs and vacancy allowances. I certainly understand that. So for this example, we're going to call it a wash. That $382 is going to go towards our property manager. It's going to go towards capital expenses, right? Replacing the roof, or money we set aside to replace the roof 5, 10 years down the road. HVAC systems, right? That's where that money is going to be set aside. So we've done our full deal analysis. Now let's type this into a projection calculator to see what happens after 5 years and compare how much of our net worth went up because of equity and principal paydown, and how much it went up if we use a hypothetical cash flow number. So we purchased this, we'll say in 2026, right? And we purchased it we're using our refinance value. So we purchased it for $250,000. Now we're going to leave out, we could go way into weeds with some of this. So we're staying at a high level. We're just going to use our purchase price of $250,000. We're not going to factor in that equity that we earned as much here, but hang with me here and you'll understand in a second. So $250,000 is the amount that it appraised for at an 80% loan to value, 6.5% rate, 30-year amortization. We're going to consider 4% as our appreciation rate year over year, which I've seen projections that have actually been a touch higher than that. We'll use 4 though. And then for cash flow, we had talked about using, right, this one penciled out to, after all of our expenses, maybe it cash flowed broke even. But if I were to tell you guys that, hey, the single family home that you can pull most of your cash out of, it also cash flows $300 a door, I think a lot more people would be very interested. So for that sake, we will say that this cash flows 300 a month or 3,600 a year. So if we look at this in a projection year after year, let's go to that 5-year mark that Corey had talked about in his podcast. Your total equity gain is going to be, let's see here. If you're not, your total equity gain, if you don't factor in what you did to burn it. So this is saying just equity that I've gained from appreciation and principal paydown is nearly $67,000 after 5 years at 4% appreciation. Your total accumulated cash flow is $21,000. So what that means is 75% of your net gain is attributed to equity in the property, and it's not attributed to, right? Only 25% of that gain is attributed to cash flow. If you include what you did with the BRRRR method, it's closer to like 82% if you take off that $11,000 that you had to keep in the deal. Like 80, let's call it 80% after just 5 years. And these numbers, guys, will, as you hold it longer, equity and principal pay down is going to do way more for your net worth over time than cash flow will. So after 5 years, our number that our equity, our total equity, including that 20% down that we have, the 50 grand, we created about 40 of it. Our total equity is $138,000. If, right, we are still talking if it cash flows $300 a month. Now let's go back and change it to if it doesn't cash flow, right? If it breaks even every month, we still are, setting money aside for capital expenses or property management. But even after all that, right, it's going to break even. If we take a look at this again, after 5 years, our total equity is $116,000. Right? So if it cash flows after 5 years, $300 a month, which a lot of you guys be like, oh yeah, cash flows $300 a month. I love that deal. Let's jump on it. The difference between those two numbers, the percentage difference, right, between 138,000 to 116,000 is quite minimal in my opinion here. If the opposition is right not buying anything and staying on the sidelines. If we just look at a rate of return on this. So if we invested, right, if we used our hard money and it cost us $11,000 out of our pocket, um, and the amount we had returned was $116,000. And I understand, guys, this is equity, right? This isn't like cash. Corey had talked about that in the podcast as well. But our annual ROI is 60%. A 60% ROI. If we do say, let's go back to that example of $300 a month of cash flow and our total equity, with that cash flow added on, it's 66%. We'll round up to 66%. So the difference in your ROI is 6% if it cash flows $300 a month. And I see that as a deal breaker for so many people. And I've seen so many people not buying deals in the last 2 to 3 years because, oh, I'm not seeing the $300 a month in cash flow that I need. And my question for you is that 6% worth not doing anything with your money at all? And I think one other fun thing that we can do here is let's tie this all back into Corey's podcast a few weeks ago, right? That's we had talked. Corey and I had a conversation. And that's why I built out a calculator to see after 5 years if you did buy 10 properties, what would happen. So, for the sake of time here, I know Corey had mentioned buying like two each year, and it showing you the value if you bought two of them each year. We're just gonna say if you bought 10 of these, the same deal we just analyzed, if you bought 10 of them at the same time, um, and then what would happen after 5 years. So we're going to back this up. We're going to backdate it to if we bought these in 2021 and we bought 10 of them. If we look at our summary of our portfolio value, if we bought 10 of these, 5 years ago, I'm just right. I have to manipulate the dates for the sake of how this calculator is built. So if we bought 10 of these properties in 2021, our total equity today, if none of them cash flowed a dollar, would be 1.16 million. If they did cash flow, we could type in here, I should be able to. If we did type in $3,600 a year for all of these, and it's gonna, accumulate year after year. Shoot, I don't think it's set up for me to add that in there. I didn't do this before when I was running through this beforehand. So, um, but we know that, right, the difference on one deal, right, it's just going to multiply by 10. Essentially, that's all we did here is we multiplied it by 10 because we're at 1.16 million versus $116,000 in equity after 5 years. So again, I think it's very important in today's climate to ask yourself, is it worth not investing and maybe waiting for something that cash flows better? Or is there still a ton of value in purchasing something today, even if it doesn't cash flow well? Another huge thing to keep in mind is over time, rent prices do tend to increase. I didn't include that in this calculator here for the sake of simplicity. Um, but over time, rents are going to increase and your underlying loan balance shouldn't increase, right? Your mortgage shouldn't change. So over time, that property should start to cash flow. That's a longer term play, but that's what we're talking about here. So that is where I'm going to wrap it up on this for this podcast. I think there's more to uncover here, though. There might be a part 3 to this, guys, um, because there is so much power in this. It is just it's a lot to wrap your head around at the same time. even for myself, I've confused myself looking at these numbers. Um, but to see the difference um, be so minimal when you add $300 of cash flow a month, right? That's the something everyone looks for. I want to cash flow, 150, $200 a door. I hear that all the time. And when you see how that plays out long term and how minimal that amount is, I think it's very powerful. So, um, again, if you're looking at this deal here during the week, this is a live deal. I think bids are going to be due on April. Let's see here. April 23rd. So I'm thinking you'll probably be listening to this on April 21st. So there are a couple days here that this deal is actually going to be live. And then, something else we can do in the future is look back at maybe some case studies of deals that were fully completed and what ended up happening with them and how, you know, a portfolio changed over time. And if these hypotheticals that we're going over stand true, which I have a lot of certainty that it would stand true. So that is all for today, guys. I appreciate you hanging out with me. Hopefully, I didn't confuse the listeners too much. I tried to do a good job of explaining everything I was talking about, but I know there's a ton of numbers in here, maybe one to listen to twice. I would so highly recommend going on YouTube and looking at some of the calculators that were on there. I am open to sharing all of this. We'll have something in the show notes here. So scroll down to get in touch about some of these resources. The calculator that I am using that the folks who are watching can see on your screen right now. This one's not fully built out yet, so I might not share everything on this yet. But if you wanted to get access to some of the calculators that we're using here, the one that we initially used is a calculator right at wisconsindiscountproperties.com. It's under the investor resources tab. I'll scroll up here. Well, you guys will be able to find it that are watching along. But it's under the investor resources tab, and then it's real estate calculator. And you can actually save this calculator to as a CVS file, so you can upload whatever numbers you have right into Excel. But no, other than that, I certainly appreciate you guys listening along. Hopefully, this made you think about whether you know still investing in today's climate if you're missing out on a lot. Hopefully, it gives you some FOMO because people are still making these deals work. And yeah, that's all I got for you. So we will see you guys next time. Appreciate it again.